Again, thanks for coming.
Yeah,
this is great.
No, it's an honor. Thanks so much, Jim. Appreciate it.
Yeah, so 2016, 17, 18, Zach was coming to my town hall events, had never bought an apartment building. So if you look to the left, look to the right, you might see a person that 4 or 5 years from now is going to own $1 billion of apartments in town. You just never know who's going to show up at these meetings. So Zach's co-founder of Rise48 Equity. You'll see a number of their apartment buildings with Rise, Scottsdale Rise, whatever their names are. And since 2019, in this, you've had $2 billion worth of apartment transactions. And mostly these are now 200 to 300 unit B and C properties. Yep. Right. And currently, out of CoStar, you have 29 large B and C properties in Metro Phoenix with 5,647 units. So we'll get more into where he is and where he's been. So with that, how'd you get here? Where'd you grow up? What'd you do? How'd you get into this stuff?
Yeah, no, can you guys hear me? Is the mic working? Okay, well, thanks, Jim, for having me. Really appreciate it. Yeah, it's funny. So I quit my job in January of 2018 to try to figure out how to make money in real estate. I'll kind of go into the background a little bit, but I was trying to find other people who own apartments or anywhere I could gain knowledge. I was reading books, listening to podcasts, and I came to this meetup, your meetup in 2018, and I was like, you did the question of who owns apartments, and a bunch of people raised their hand. I was like, shit, I'm in the right spot. This is what I was trying to find. I was trying to find meetups. I went to all these meetups and there were no apartment owners, and you had that meetup. So it was kind of funny. I met Bob and Anthony at that meetup, and they ended up being our property manager on our first property. But so really happy to be here. Thanks for having me, Jim. Good to see you back out of retirement. So
yeah, thank you.
Thanks for the invite here. But yeah, so I'm Zach Haptonstall. I'm the CEO and co-founder of Rise48 Equity. I was born and raised here in Phoenix, so lived here my entire life, and I just grew up in like a lower middle class family. You know, no real estate background, no rich uncle or backer or anything like that. My dad worked in construction. My mom worked in like HR for an accounting firm. And so like most people, you know, I was taught you go to school, get good grades so that you can get a degree, get a good job. And so I always had good grades. I was an athlete. I played high school football here. I had a Division II football scholarship to a small school in Colorado. Did that for a little bit. Realized I wasn't big enough or good enough to go to the NFL. So my next plan was to be a sports reporter. So I got a journalism degree at the Walter Cronkite School of Journalism at ASU. And I was a live news anchor on Arizona PBS and hosted a show on Fox Sports Network for a short time, which, you know, was cool at first. And then I quickly realized, Jim, you can't make any money in journalism. And it wasn't as fun as I thought. It's like, this sucks. I'm not making any money. So I graduated. I was 21. I had been working full-time nights and weekends to kind of pay my way through school. And I was delivering medical equipment at the time, just a weird, odd job. And I needed to make money to pay off my student debt, et cetera. So I found out I can make money through healthcare marketing. So I went into hospice marketing, of all things. So for those of you who aren't familiar, hospice care is basically mobile nursing caregiving for people who have terminal illnesses. So my job is I would just wake up in the morning, drive all around Phoenix and cold call, walk into hospitals, doctors' offices, assisted livings, et cetera. When they had somebody need a hospice, they call me, and I meet with the family, the patient, get them signed up. So it sounds weird, but it's a very competitive, lucrative, private business industry, all regulated and reimbursed by Medicare. So anyways, I did really well at that. By the time I'm 23, I'm making like $150K a year, like more money than both my parents combined had ever made. I started going to night school, so I was paying cash for my MBA. When I was 24, I got my MBA. I bought a house when I was 23. I was following the Dave Ramsey plan, you know, just trying to stash cash. So I was fortunate to do really well. By the time I'm 26, I'm making like $200K a year. I'm a director of marketing, managing a team. I had no debt except for my house, but I was completely miserable because I was, you know, working crazy hours doing something I didn't really care about. I was just trying to get, you know, financial freedom, so to speak. And so I was trying to figure out, like, hey, how can I stop working and just create passive income? Like, instead of constantly trading my time. And I didn't know anybody in real estate. I had never heard about multifamily, never heard about the concept of syndication. It's kind of like a cliche story a lot of people have probably heard, but I read Rich Dad Poor Dad, right, in December of 2017. And at that time, the company I was working for had promised me like a bunch of equity. I was making them millions and millions of dollars. They were going to sell. And I realized, you know, I don't want to be a part of this. And so January 2018, the next month, I said, screw it, I'm out. So I quit. I had no plan what I was going to do. I was just going to try to, somehow create money through real estate. And so I had relentlessly saved money for like 5 years, and I got a little pop of sweat equity I had earned from leaving that company. So I had almost $300K of cash, Jim, in January of 2018, which I thought was like a ton of money. I was like, I got $300K of cash. Like, I'm going to do great. I'm going to live off the savings. I'm going to figure out how to make money in real estate. And initially, I was thinking of flipping houses. So that's what I was going to do, is flip houses. And I quickly realized it's very transactional. It's kind of what I just left with my job. And so I was like, how do I create income? So I just started to immerse myself, reading books, podcasts, trying to go to any local meetups like this one that I could do. And I started learning about investing. And initially, I was really interested in mobile home parks, right? Because everybody's like, oh, those things are a cash cow. There's just a ton of cash flow. So I cold called over 90 mobile home park owners in Mesa, Apache Junction, trying to buy one on a seller carry with my cash. Didn't work out. And that made me realize, Jim, that the $300K of cash doesn't go very far in commercial real estate. It doesn't get you anything, really, especially when you don't have a job and you're burning money every week. And that's really discouraging, by the way. That was a tough, because I went from being the man, getting fat paychecks, wake up in the morning knowing what you're supposed to do, to wake up in the morning and you don't have a boss. Like, what the hell do I do today? I started to feel worthless, honestly. I was like, what am I doing? So 2 months go by, 3 months go by, 4 months go by, and I was trying to learn everything I could, and I learned about multifamily and this whole concept of syndication. And that really kind of, the light bulb kind of went off, where I was like, you know what? My $300K doesn't go very far, but if I can leverage my time and energy, and I can leverage other people's money, I can actually create compensation for myself without having to have money. And I can scale this thing, and there's really no ceiling. And that was really interesting to me, because I was researching mobile home parks, self-storage, and I kept getting discouraged by each asset class, because at first I thought I found a hidden gem, and then I realized it's super competitive and saturated. I got discouraged, cap rates are compressed, and then I realized anything that is successful is super competitive. That's why it's successful, because people are going to flock to it, right? So I was like, you know what? I got to change my mindset, and they have to compete with me, not the other way around. And so I said, I'm going to do multifamily syndication, and that was kind of my primary goal. So I was like, okay, my net worth was literally $300K, dwindling every month. I didn't have any family that could help me. I didn't know anybody, literally. I'm not exaggerating. And so I started going to meetups like this. I started going to conferences. I met my first business partner at a conference, because I knew that the first thing I needed was like a balance sheet guy. I need somebody that can sign on these loans with me, because I didn't have net worth liquidity. So I met my first partner, Robert, at a conference in July of 2018. His wife is a physician. Their net worth was like $3 million at the time. I was like, okay, this is my balance sheet guy. He can help me sign on the loan. He lived here in Phoenix, and he had never done a deal but wanted to do one. And then, long story short, 10 months go by, okay? And I'm waking up every morning like super discouraged. I lost all my confidence. I feel like I have a monkey on my back. Really? Yeah, because I couldn't get a deal, and I would go to like family events. People are like, oh, what do you do? I say, I'm a real estate investor. I say, oh, what do you own? I was like, well, I don't actually own anything, but I read a lot of books. I could tell you all the people at the meetups, and it was tough, you know what I mean? Because it's like, it's a true entrepreneurial challenge, and I was on that journey, and it's discouraging. I would call brokers, they don't take you seriously, but you have to push through all these different levels of psychological pain, so to speak. Like, I remember calling the first brokers was like the big first thing I had to overcome. I was so nervous and so stressed out to just meet with these brokers, because you feel like you don't belong. These buildings are big, the numbers are big. But you got to meet with the brokers, then you start underwriting deals, or try to underwrite them, act like you know what you're doing. I remember we sent an LOI, and I was terrified to send an LOI. Anyways, October of 2018, 10 months go by, I'm burning money. We sent an LOI on a 36-unit deal called Silver Oaks, right across the street from Grand Canyon University, and then the seller accepts it, and we're like, oh shit, they accepted it. And what do I have to actually do something now. I got to move forward, and so Robert, he wanted to bail. He was like, no, I don't think this looks like a good property, because we had a 30-day due diligence, and we had $50K of earnest money. I did 25, he did 25, and we were like at day 28, and I was calling all the people I had met the previous months at the conferences who said they wanted to invest. Yeah, Zach, sounds great. Let me know when you get a deal. Hey, I got a deal. Oh, no, now's not a good time. Nothing. It was a $3.4 million purchase price, had to raise $1.4 million. and the money's about to go hard. And I was like, no, screw it. Let's just let it go hard. We got to find a way. And so we did that. I had 165K left. I was burning through money, joining mentorship programs, traveling to conferences, and I put 160 in. So almost all my money. And I told Robert, I said, I'm all in. I need you to help out here. Put something in. So he put 275 in. We met our third partner, Bikron, in escrow. I met him at a conference, and he's like a finance guy, CPA, economics degree. And I talked to him, and I honestly didn't not even see a role for him. I kind of like was trying to like sell him like, yeah, you can be an equal partner, blah, blah, blah. But in my back of my mind, I was like, I just need your money. We'll get you in and figure it out later. He ended up being really valuable later on. And then I found a 1031 exchange investor, okay, of all things. Somebody reached out to me, and they were like, hey, I heard you have a deal. I just sold this property. I have 650K. Do you want to do a 1031 exchange and a TIC structure, a tenant in common? I said, yeah, let's do it. I said, what's a TIC structure? and I learned what that was. And so anyways, we bootstrapped that thing. It was a long, grueling, 4-month escrow. Got it closed in February of 2019. And I'll say a little bit more, and then I'll stop, Jim. I know you have questions. But my plan was to scale. Like, I wanted to buy 1,000 units in the first year. Because I read all these books, listened to these podcasts, talked to the people that say, yeah, I started out flipping homes. I started out buying duplexes. I wish I would have started bigger and scaled faster. So I had that in the back of my mind. Like how can I learn from other people's experiences on trying to collapse a time frame? And so I just had to try to think big. And so December of 2018, I was 2 months into that first escrow, not knowing if we were going to close. I knew that I had no more cash and that I wanted to buy another deal and obviously needed money to pay my bills. And so I told my then girlfriend, now my wife, Grace, I had bought a house, right, like 3.5 years earlier. And I was never going to sell that house because it was my first house. It was sentimental, et cetera. And I said, hey, Grace, I got to sell this house. I need the money for earnest money. So I put it on the market. Right after we bought Silver Oaks, the first deal, I sold the house. And a week later, I made $120K from the house, and I wired $100K non-refundable day one on a 2-property portfolio. One of them is actually over here by 64th Street Indian School, Scottsdale 5th Avenue, 59 unit, and then a 76 unit Oak Tree. So we won a 2-property portfolio, and we were all in. So we had to bootstrap that thing, another 4-month long grueling escrow, try to find the money. And so it was always just kind of, find a way. So anyways, long story short, we can go into details wherever you want, Jim, but
So I have a question.
yeah, go ahead, sorry.
And so I remember that Zach did a presentation a year or two ago at one of these type of things, and I hadn't seen you for a long time. And I asked him, I said, you've got this gal friend, and you have no money, and you're spending your money. And I said, how did you convince Grace you could do that? And Zach was really nice. He looked around the room, and he said, Grace, you want to answer that question? And she was just, you got to know Zach. You got to know he's going to get this thing done. But the point is, you got to have a good partner.
Yeah.
And you have a really good partner. Now you've got a
100%.
son.
Yep.
And
No, it's a great point because I went into credit card debt. Like in 2019, I was like $12,000 in credit card debt. We owned 4 assets. By September 19, we owned 4 assets, $35 million of real estate. And on the outside, you would think, oh, he owns $35 million of real estate. But I put all my money into the deals as skin in the game. And the preferred return is all the cash flow is going to the investors. None of the deals had sold, and I was dead broke. So Grace was paying our bills. She was covering everything, and she kind of believed, she believed in the dream, so to speak. And so, so basically, 2018, bought no deals. 2019, bought 4 deals, $35 million. We were catching momentum. 2020, COVID hits, kind of slows us down. So we bought 2 deals in 2020. In September of 2019, a little bit over 18 months after I had started the whole thing, I was broke, like I said. We couldn't find a deal, and I needed money. And so I had a non-compete with my previous hospice company that expired, and I actually went back into hospice. I had to go back and get a job, Jim. Because I was broke. Most people don't know that because I don't like to talk about it. But I had an opportunity to become like the president and co-owner of a different hospice company. So I took that job because I needed the money to get out of debt. And so from September of 19 through February of 2021, about another 18 months or so, I was working full-time as a president and co-owner of a hospice company. And we had like 50 employees when I started. We scaled it to like 110 and sold it to a private equity firm. My partner, Bikron, he had a full-time accounting job in Irvine, California. He wasn't even here. And so we were running the company at night. So everything we were doing was nighttime Zoom calls. And so anyways, 2018, 2019, 2020, we bought like 6 deals, 60 million, made $0. I made no money the first 3 years. And by the end of 2020, Jim, it all kind of started to click because we started selling our first couple deals, right? So we sold Silver Oaks, it was like a 2.5 multiple, so I get flush with liquidity. By then, we had bought 6 deals, so the local Phoenix brokerage community kind of knew that we were serious and that we did what we said, so we started getting off-market deal flow. We started to charge acquisition fees on our deals. We never charged that initially just because we wanted to prove our concept out to investors, and that generated revenue. And so Bikram, being the smart accounting background, he was like, hey, and at this point, there was no Rise48. It was 3 guys with their own brands. I was ZH Multifamily, Bikram was Bright Investors, and Robert was RNA Real Estate Investors. And Bikram, by the end of 2020, he's like, hey, let's just start a real company with a combined brand and kind of quote unquote get married. He's like, Zach, you'll be the CEO, I'll be the CFO, and Robert, you run Chief Construction Officer. And he's like, we'll convert it to an S Corp and give ourselves salaries. I was like, okay, that sounds like a good idea because, a lot of you guys may know when you start doing co-GP, it starts to get weird, Jim, because you don't have defined roles, right? It's like I've got these 2 friends. Who's going to be the true alpha of the group? Who's going to make the call at the end of the day? If there's disagreements, who's the finance guy? Who's the money raising guy? And by the way, I didn't even go into it, but I had quote unquote dated 7 or 8 different business partners prior to meeting Bikram and Robert. Meeting people at conferences, meetups like this. You're like, hey, you want to underwrite deals together? Some people didn't want to work as hard as I did. Some people, we had the same skill set. I had one guy, we did nightly calls for 2 months, and he was like the same exact skill set as me. And I was like, I need a finance guy. That's my complementary skill set. So, I cut him. And so you have to find that perfect partner. It's kind of like getting married in a business. So anyways, we became a real company, so to speak, in the end of 2020, Rise48. In March of 2021, February 21, I quit the job. Bikram called me in January 21. He's like, hey, I just quit my job. I'm moving to Phoenix. I was like, what the hell? Are you serious? I'm going to quit my job. So I quit my job the next month. And then we got an office the next month after that. So we got an office in March of 21. And so the first 3 years, we bought 6 deals, 60 million. In 2021, we bought 16 deals, 560 million. So everything just started, cranking. Like we were selling deals, 1031 exchanging them, getting flooded with investor referrals, doing podcasts, conferences, et cetera, getting all the deal flow from brokers. 2022, we bought another 16 deals, 860 million. So we bought like 1.3 billion in a 24-month span. We sold the first 11 deals, and they were, home runs for investors. In 21, we said, hey, we want to become a vertically integrated firm. So all the profits that we were taking, we reinvested into infrastructure. We started our own property management company to manage everything in-house, started our own construction management company, started buying all the materials directly wholesale from an overseas manufacturer so we can control our supply chain, and really started doing higher level interiors, okay? So basically the first, we made money for like 12 to 18 months, okay? The first 3 years made no money, then we started making money, and then interest rates start to shoot up. And we're like, oh shit, here we go again. Like first we had the startup, then we had COVID stop us, then we get momentum, then interest rates come back. And so basically interest rates started increasing in March of 22, and that slowed us down second half of 22, and kind of our saving grace to get through this entire storm has been the ability to renovate units on schedule and on budget. So as many of you guys know, tons of groups, it's almost common now in the space, have done capital calls the last couple of years. It's just become, a necessary thing. We have not missed a single monthly debt service payment to any lender, never done a capital call on any asset ever, and never lost investor capital. Now, we were taking out floating rate debt just like everybody else, right? And we should have bought lower caps. So basically what was happening is that, and it's funny because some people say, oh, you're a reckless syndicator. You people hear that, Jim? You have groups like Blackstone and Brookfield that have gotten foreclosed on in the last 24 months, right, with the same type of debt structure. So we've done fixed rate debt. We've done floating rate debt. Our first couple deals were 10-year Freddie Mac fixed rate debt, and we got crushed with prepay penalties called yield maintenance defeasance when you go to sell. So the reason people do floating rate is because you have flexible prepay penalty, so you can sell or refi. Now, the mistake that we made, and what a lot of people made, is that we were buying deals where we always bought 3-year interest rate caps, which was also a saving grace. Go ahead, Jim, sorry.
No. 3-year interest rate caps.
Yeah.
And then what happened after the 3 years?
So after the 3 years, the cap expires.
This is critical because a lot of companies,
Yeah.
like the Tides and things, they're in foreclosure, they're giving properties back. So
Yeah.
understanding what Zach is doing or has done is critical if you're going to do this kind of thing.
Yeah, no, I'll be transparent with how it's been. It's been like living in hell for 2 years. It's stressful as hell. We have like the real deal talking shit about us all the time, hit pieces and stuff. So I have to like combat them. Yep, go ahead. Yep.
Do you want to stand up and talk, and we'll see if we can repeat it?
Yeah. Yeah, I think he said, how are you doing with your DSCRs, right? Yeah, so DSCR is a debt service coverage ratio. So basically, kind of back to what I was saying, is that I'm buying a deal where I'm buying it in like the low to mid 3% interest rate, okay? I'm buying a 3-year interest rate cap where my max all-in rate is around 5.5% to 6%. Now, we were looking at Chatham Financial and the forward-looking interest rate curves and what they were projecting interest rates to increase. We were building in 1% to 2% of interest rate expansion into our model in the first 2 years, which was higher and more conservative than Chatham Financial and all these forward-looking curves were projecting. In hindsight, those curves were worthless because when the Fed starts to increase rates, I went from like 3% to 6% in less than 12 months. So for example, from June of 21 to December of 21, we bought 11 deals. They all went to negative cash flow within a matter of months, meaning your debt service exceeds your NOI, right? And so we're like, oh shit, what are we gonna do? Well, all we could do was renovate the units and execute the business plan to increase NOI. And that's what we did. And so in 2023, so at this time, remember, a lot of people did not have 3-year caps. Most people, if they even had a cap, had a 1 or a 2-year cap. And there's been deals that have already been taken back in Phoenix, which we'll talk about distress.
A 1 or?
They've only had a 1 or a 2-year cap. A lot of groups, not a lot of groups, some groups didn't have a cap at all. And those groups are already basically toast. But basically, most people, even if they had a cap, did not want to renovate units. They wanted to preserve liquidity at the property level to cover the higher DSCR, right? We took a contrarian approach. I remember it was like Q3 of 22, and we're sitting with I took all of our ops staff in the conference room. There was like 12 to 15 of them, and I said, guys, basically, we're sitting in our house, and there's a burglar banging on the door, and the burglar is the interest rates. And we can sit here and let the burglar come in and kill us by doing nothing, or we can, grab our gun and go shoot the burglar. And grabbing the gun and shooting the burglar was kind of our contrarian approach to be aggressive and crank up renovation velocity. So that's what we did. We beefed up the construction staff, and in 2023, we renovated 1,923 units in 2023 alone, all to our high-level scope, which we gut the entire unit. We do quartz countertops, stainless steel appliances, brand new cabinet boxes, LED lighting, brand new flooring, everything, light fixtures, ceiling fans. We don't do like lipstick on a pig because we're getting wholesale pricing. We had an average rental increase across those 1,900 units of $453 per unit, which was $20 above our initial projected rents. So of those 11 deals that went to negative cash flow, 9 of them are now back to cash flow positive, just from renovating units and forcing appreciation. The other 2 should be cash flow positive next year. Okay, and so what we were able to do is that we gave 0% interest loans from our property management company to the asset. We'd always raise reserves as well. So a lot of these deals still had their reserves left, but some of them burned through reserves. We gave an interest-free loan from our management company to the asset so that it could front the cash to buy materials, pay vendors, complete the work, submit the draw to the lender, and then it gets reimbursed and the loan gets paid back. And so because we had created this vertically integrated structure where I'm earning property management fees, asset management fees, construction management fees, we were large enough to kind of get through that storm and be able to, crank through it. Now, we can get to the distress story. The reality is there is not widespread distress in Phoenix. Okay, there's only a couple operators I know of. I mean, you guys know one of them in the headlines, right? They're distressed in every market. But there's not widespread distress because the reality is that Phoenix is a very institutional market. Okay, and most of these deals are well capitalized. And so we have not sold a deal, Jim, since July of 2022. We sold 5 deals the first half of 22. They were all home runs for investors. And then we had 2 on the market in the summer of 22, and we took them off the market because rates were going up and values were going down. And we said, we're not going to give buyers a discount by selling right now. And so we've now modified 9 or 10 of our loans. So every 2020 loan that's come up, So basically, we have 2021 loans that are 3-year maturities and 3-year caps. They've all been expiring. I think I've had like 7 or 8 of them in the last 90 days. Every single loan, I'm getting on the phone with like the president or the CEO of the REIT, because these lenders are debt funds. These are publicly traded REITs. And I've been talking to these guys for 12 months. And I get on Zoom calls or meet them in person and say, hey, we're going to support the asset. I need a modification. I need you to extend me out. And every single one of them has done it. Okay, so they're basically waiving debt service coverage ratio covenants or debt yield covenants and giving me 12 to 24 months of term in exchange for us buying new caps. Now, not all borrowers are created equally. We've been able to hit our pro forma rents across the board, and that's despite last year there being negative 4% organic rent growth. We still pushed rents. Borrowers that have crappy operations and that the lender does not believe in, they're not willing to work with them because they don't see the light at the end of the tunnel and they're taking the deals back. So in Q4 of last year, Jim, I had 2 different lenders reach out to me and said, hey, confidentially, we're doing deed in lieu foreclosures on other borrowers in the market. Would you guys want to come in and buy this from us for the loan amount? And I said, hey, thanks for thinking of us. We underwrote them. We couldn't even get to the loan amount. It didn't make sense for us. So some of the deals that have already been foreclosed on, we could have bought them from there, but it just didn't make sense. Go ahead.
So are you not looking to buy distressed assets? People are coming to you to say, do you want to help us? But you're not out there actively looking.
We are actively looking. The problem in Phoenix is there's no deal flow. There's like nothing happening. We were the number 1 buyer in Dallas-Fort Worth last year in the entire country. We entered, so basically, I've been telling you kind of the lead up to 22, and then I've been telling you the defense strategy the last couple of years. Well, we've also been on full offense. So in Q3 of 22, I realized, you know what? Now is the time to basically attack our competition because everyone's on the sidelines, nothing's transacting. This is our moment to get into these extremely competitive markets. So we opened up an office at the end of 22 in Dallas, and we've been buying distressed assets in Dallas for the last almost 24 months.
Go back and tell us why you went away. You set up your assets here in Phoenix, and you said, okay, where can I go to be on the offense and buy more properties with my scenario? So why Dallas?
So I know every top broker in Phoenix, and I talk to them regularly, and none of us can figure out why there isn't more distress in Phoenix. Okay, the reality is that lenders are working with groups. As long as you are paying your debt service and you will buy a new cap and you are a competent operator, they're extending you out. And that's why we're extending all of our loans out. We have no issues. Like some people are like, hey, I'm going to threaten to give back the keys. That does not work. You piss them off, and then they'll go into, like, I have to sign pre-negotiation agreements with these lenders, which is like NDAs and all this shit that you have to agree to. And you have to basically get them to be disarmed. You have to be like, hey, I'm going to support the asset. Don't worry. How do we work together? So there has been a lot of distress in Texas. I mean, there's a lot of smaller groups that aren't as well capitalized in Dallas. I mean, we just closed a deal last Friday. We bought it for the loan amount. They wiped out all their equity. They bought the deal for $35 million in September of 21. 3-year bridge loan just expired September last month, and we bought it for $28.6. So they wiped all their investor equity. We've bought 6 or 7 deals this year. Same exact story.
Tell me,
Just Phoenix, we haven't seen them. Like in Phoenix, for whatever reason, I think it's because it's mostly institutions. There have been a few deals, but it's not widespread.
Yeah.
Yep.
Take a microphone.
I heard a rumor that Class A is transactioning pretty well in Phoenix. Do you think that that's why the B and C markets aren't moving as fast, as that it's happening in a higher tier?
It's a good question, Anthony. I mean, so you've seen some 60s and 70s vintage deals that need to trade for like a loss. I don't know the data. I think there's less than 5 1980s vintage deals that are 100 plus units have traded this year, which is insane. There just hasn't been a lot of those. Class A, has been trading because a lot of these groups are basically saying they can buy these deals below replacement cost, right? And a lot of these bigger groups that are buying Class A, they have a lower cost of capital than we do, meaning that they can tolerate, a low return because you can't push those rents. And honestly, if I can go buy a 2024 build and slap 10-year fixed rate debt and do nothing, that's all I would do. What I do now is stressful as hell. So I would rather do that. But the problem is you don't get as good of a return. And we can't, my cost of capital is higher for our investors. There's an expectation. Yes, sir.
Is it me? Oh, I'm sorry. Hot mic. Anyway, I wanted to find out, so just on your renovation, on average, what are you guys spending on your renovations?
Yeah, good question. So basically, he's asked, what are we doing on the renovation? So we have contracts with our supplier for materials. And so we have our general contractor license. So we are the GC doing the construction management, but we use third-party construction companies do the actual in-unit labor. So we make sure that our construction vendors sign contracts upon the beginning of the investment where I am paying them a flat price per door for labor for the lifetime of the project. I think it's like a 5-year contract. And then our materials with our supplier, same thing. I don't care if it's a 1-bedroom, 2-bedroom, or 3-bedroom. I'm paying them a flat dollar per unit for the lifetime of the project. So for the deals we bought in 21, we've renovated a lot of those 100%, but we're finishing some of them up now. All in for that high level scope, like quartz, countertop, stainless steel, everything. I'm at about 12,500 all in labor and materials, all in.
That's great.
And I'm still paying that today for my labor materials all in. The labor has to use our materials. So I'm buying all the materials directly wholesale from an overseas manufacturer at fixed pricing. The supplier has local warehouses in our markets. They ship them overseas. They build custom kits. So basically, they will deliver the materials inside our unit. Like, we're the only ones that'll do it inside the unit. For whatever reason, they don't like to do that liability. But they'll drop 3 to 4 pallets, and our guys go in there and open it up. And if it's a 600 square foot 1-bedroom, then it has the vinyl plank measurements flooring just for that. It has prefabricated quartz countertops for those measurements. All the cabinet boxes are already assembled, and our guys just crank through. Right now, we're renovating. This is mostly in Dallas because we stopped renovating in Phoenix for the most part because we've renovated most of them. We're renovating right now about 200 to 220 units a month in an average of 21 days per unit. So that's how efficient it is. And so anyways, to answer your question, today, if I buy a deal today, I'm at about 16.5 all in. And that'll be locked in for the next 5 years.
Fixes unit?
Yeah, what's the lease up like?
Yeah.
Yeah, good question. So we don't just empty out the asset, okay? So we are typically projecting to renovate the entire building in the first 24 to 36 months. So we want to keep the deal at a minimum of 85% physical occupancy during the entire investment period, because it still needs the cash flow to support the asset and produce cash flow to investors. And so let's just say that, for example, it's a 200-unit deal, and I have 10 units that have expiring leases next month because they were signed 12 months prior. Well, in the markets that we're in, which we have offices now in Phoenix, Dallas, Charlotte, and Greensboro, North Carolina, we have the right to non-renew these tenants. So we say, hey, we're sorry, your lease is expired. We're not renewing you. You have to get out, leave, move somewhere else. We immediately demo the unit, renovate it, lease it up to a new tenant within 21 to 28 days. And so we're doing that every single month. And so we've got, we are on Rise48 Construction, our W-2 employees, we have supply coordinators who receive the supplies on site, make sure it's all there before we sign off, and we have liability. Then we have construction coordinators who are walking units 40 hours a week, making sure it all stays on schedule, on budget. Then we have quality control staff that will review it after it's done and release the unit to our on-site manager and maintenance staff, and then they'll go and lease it. And so we do the exact same scope on every single unit, and we just rinse and repeat and kind of crank through it.
So there was something that is this working? Yeah. So we went through the subprime lending time, 2008, 9, and 10, and it was very difficult to work with lenders, and we were approaching lenders on behalf of owners and things, and sometimes we were able to do short sales. The nice thing is that lenders have learned. Talk to the owners, work with the owners that are competent, that have a game plan, and this is exactly what you've done. Stay in contact with them, show them where the light at the end of the tunnel is, and that's going to help.
Yeah, no, a communication, it sounds cliche, but it is true. And trust me, it's intimidating. Sometimes I get on these Zoom calls and I'm like shaking. I'm like, I hope this guy doesn't ruin my life today.
I can't believe you'd ever shake for anything. You just don't seem like that kind of a guy.
I tell you, I live in a constant state of pressure, fear, and anxiety. But it's just you keep pushing through it, honestly. But basically, if you have good communication, do what you say you're going to do, it's been paying off. And out of all this, turmoil has actually come a good opportunity because we have actually now had lenders who have asked us to manage assets that they have taken back. And so we actually just started a third-party property management company, and last week we took over 3 assets, 650 units in Dallas for one of our lenders. They foreclosed. So like our staff just hired 11 people last Monday, and they foreclosed on 3 assets in Dallas, and we just took those over for third-party management.
How big is your staff?
Right now we have a little over 260 full-time W-2 employees on full benefits across the 3 markets. And so yeah, I mean, that's been beneficial. And so now we'll do, I mean, I endorse Avant-Garde. I love these guys, Bob and Anthony, so we're not here to compete with you guys. Yeah. So,
You use these guys to start with,
they
right?
were our manager on our very first asset, did a great job. Yeah, they got us going. They got us rolling. And that was a tough asset. It was drug dealer, gangbanger, prostitute, 1960s vintage deal.
Right up
And
your
they made
alley.
Yeah. That's their specialty. Yeah. So basically, to where we are now, I mean, I can tell you that right now we are finalizing a cash neutral refinance on one deal that we bought in 2021. The biggest challenge right now is most of these deals, the debt yield is not there to make sense. And so it's all about how do I extend my horizon, my term of my loan, so that when rates cut and supply starts to dry up, okay? We didn't even talk about supply. I mean, obviously interest rates have been a pain in the ass, but all the new supply has been contributing to this, right? So from 2019 to 2021, you look at all the Sunbelt growth markets took off, right? And developers saw that and said, let's build new apartments, right? Phoenix was #1 for population growth for several years, all coming from, all the progressive markets, LA, et cetera. And so most of that got delivered, that new supply got delivered in 2023 and 2024. I mean, there was a stat from RealPage that in 2023, there was more new supply of apartments in the United States than any year since 1985. And so you have interest rates skyrocketing. You have Phoenix especially. I think Phoenix was top 5 in the country last year for new supply. All these new apartments flooding in. And then you've got people, the residents, where inflation has caught up to them, right? And so they can't hardly afford their groceries, their gas, whatever. And so that's why your organic rent growth in 2023 was -4%. It's just basic supply and demand. There was more supply than there was demand. And so what's happened is that occupancy has struggled in Phoenix for now 24 plus months. Rents are going backwards. Concessions are significant, Jim. I mean, this started in Q2 of last year where everybody around us is giving at least a month free. So you have no choice but to give a concession. In the Class A, they're getting killed. A lot of them, my sister just rented an apartment 2 weeks ago in North Phoenix. She got 2 months free, Class A. They're still doing 2 to 3 months free rent. And so everybody's been undercutting each other. Were you going to say something, Anthony?
Well, it trickled down.
Yeah, now it trickles down. We always, yep, go ahead, Rick.
Oh, no, that was all. Sorry, I'll stay out of it.
Just saying, so we always thought, Jim, that, we're in workforce housing. I'm buying 1980s vintage deals. We're insulated towards Class A because my tenants can't afford those rents. Well, this crazy phenomenon has happened across the country where when Class A is giving 2 or 3 months free, these tenants that could never afford it, all of a sudden they're going and taking advantage of that, writing out the concession, and then they're just skipping and they're just jumping from property to property.
So one of the things that when they say the rents have gone down, it's true, but they've actually gone down more. The cash flow has actually gone down more because the owners try to keep the rents. If you want $2,000 for a rent or something, they'll say, it came down maybe to $1,950, but they don't tell you they're giving those 1 or 2 months concessions. So
Right.
When the rent comes down a little bit or the vacancy goes up a little bit, your cash flow really goes down much more. It's impacted much more. So we've got about 5 minutes more, and I'd like to ask Zach to.
We got one more question back here.
Yeah, let me get your mic.
Sure, go ahead. Oh, yeah, my name is Marco. Zach, I know you're controlling costs, on wholesaling, the materials and things like that and labor, 5-year contracts into it and stuff. How do you control insurance? Insurance lately has been nuts, skyrocketing. So how do you control that cost?
Yeah, speaking of insurance, good question, Marco. I endorse Ken Plitt over here. So Ken did our first 30, 40 deals in Phoenix as insurance. So if you need insurance, Ken's a great guy over here in the blue shirt. So fortunately, this is another reason you're not seeing a ton of distress in Phoenix, by the way. It's a good question. I didn't remember that, is that property taxes and insurance are not a big challenge in Phoenix, okay? Because in Phoenix, insurance has gone up, right? I think but it hasn't. It's gone up maybe 20 to 30%, but it was starting at such a low basis. I think right now we're around 250 to 300 a unit for Phoenix insurance. Dallas is $1,000 a unit, right? Florida pre-hurricane, pre-Milton was 2,000 a unit. And the other thing is that in Arizona, there's legislation in place where property taxes cannot increase by more than 5% year over year, regardless of a sale or reassessment. Well, in Texas and Florida, there's no state income tax, but what they do is they gouge you on property taxes to compensate for that and generate revenue for the counties. And so what happened is that's why there's so many foreclosures and people just getting completely wiped out in Texas. It's not because it's not a great market. It is, but they're getting hit with the triple whammy of interest rates, property taxes, and insurance. Now, fortunately, so to answer your question, in Phoenix, you have not seen a ton of distress because people are extending and property taxes and insurance aren't really a big factor. The insurance has not been painful enough to make a difference. But in Dallas, people are just getting crushed. Now, fortunately, we entered Dallas at the end of 22, and that's when the writing was on the wall. People were already getting crushed. We're like, okay, we need to make sure that we have the right consultants. And so, like, all the deals we bought like 8 deals last year in Dallas, over 2,000 units, I think, and all our reassessments came in this year totally fine. Same for insurance. We've built that contingency in. But that is one of the saving graces of Arizona, is that it's cheap on property taxes and insurance. Yeah, good question.
Steve from Phoenix. Did you look at the Vegas market?
Yeah, good question, Steve. So Vegas was going to be our market we wanted to expand. Like 2020, 21, we were looking at Vegas. And then we were actually going to decide between Vegas and Dallas in 2022. And I have some friends that own stuff in Vegas. And in like Q2, Q3 of 22, they were like, it's a bloodbath. Like, delinquency is trending up. It's been really tough. And it's because they don't have this is what people have told me, because they don't have a very diversified employment base, right? It's heavily concentrated in tourism, hospitality. And so that's why, Phoenix and Vegas have always been very boom or bust, right? But Phoenix is now very diversified if you look at the employment. And so I don't think we like Phoenix. I would buy Phoenix deals now if you got anything, Jim, but we can't find anything. So we don't like Vegas. Like, we don't want to, we'll third party manage Vegas. We don't want to buy in Vegas. We like Dallas because of the employment. Don't really like Houston, honestly. We're in Charlotte and North Carolina, and we're actually,
Let me,
yeah, Austin's a good question. Austin would be my only other market that I like in Texas. The problem with Austin is that they don't have a lot of 1980s, 1990s vintage deals because it's all newer, right? So we couldn't build scale there. Like I like Boise, Idaho, but I could go buy like 100 units and then I'm done because there's nothing out there. So.
So I've got these 4x5 cards that are handed out with you guys. So, and I've got to cut Zach off, but I got a couple more questions for him first. But if you've got those little 4x5 cards, Chris, hold that up, see? Write some questions down, and I will get your questions back to Zach. But I want to ask him, actually kind of lead him. So, do you think Zach's impressive? What do you think? Right? Amazing, right? Now, if president. All right. We're not talking about the election 2 weeks ago.
28, yeah.
If somebody wanted to invest with your group, Rise48 Equity, how would they do that? Should they contact you? Do they contact Cassidy? Who do they talk to?
No, thanks for asking, Jim. So basically, we're regulated by the SEC, so we can't solicit our deals, the type of offerings we do. So you basically, you can give your info to Cassidy or one of our team members, or you can go on our website and you can set up a call with one of our team members online, and that allows us to compliantly create a relationship. Then we would put you on our investor list going forward. So that's the thing, is like, our deals are not available to the public. We have to either have been referred somebody or have a phone call. One of our team members has a phone call.
Okay. So, and then one last question. There's sort of a rumor out there from people about where you want to go with this concept. Where do you want to be in 10 years?
Yeah, no, so our goal, I've been saying this for like 3 or 4 years, and it sounds kind of cheesy, but our goal is to be the largest and greatest real estate company of all time. Like, we plan to be bigger than Blackstone. And I know that sounds crazy, but we honestly think it's possible. And that's why we're creating other lines of business, right? Like,
you guys are sitting here listening to Zach. And 10 years from now, you're going to go, I was at that meeting. And he's like this huge guy, and I was there at that meeting with him. So this is so impressive to have you attend here and talk. I feel blessed that you actually take the time and do this.
No,
And
thank
to
you.
meet
And I'm
Cassidy
always
and
happy
this-
to help. Yeah, yeah. Don't believe the hype. Don't believe the hype, guys.
All right, Zach.
Thanks, Jim. Really appreciate
No,
it, man.
this
Thanks
is
so
great.
much.
No,
Yeah,
thank you for coming out. I appreciate your time and effort. And how about that for an amazing
Yeah,
story,
thanks
huh?
so much, guys. Appreciate it.